Every dividend investor knows the VanEck Morningstar Developed Markets Dividend Leaders ETF. It offers strong country diversification, excellent price performance, and a very impressive dividend track record. No wonder its popularity has absolutely exploded over the last few years, even catching up to Vanguard's legendary Dividend ETF. However, this ETF has a noteworthy drawback. Its domicile is in the Netherlands, which can create a tax disadvantage for many European investors. On top of that, more and more European investors are actively looking for U.S.-free funds to reduce their U.S. dollar exposure. But here's the good news. VanEck has recently launched a new Dividend Leaders ETF that directly addresses these issues. Today, we're looking at the brand new VanEck Morningstar Developed Markets ex-US Dividend Leaders ETF. Usually, this channel is all about building cash flow with dividend ETFs. But today's video is a bit different because this new VanEck ETF is currently only available as an accumulating fund. That said, we can definitely hope that a distributing version will follow soon. I have already reached out to VanEck to ask if a distributing version is on the way, but I haven't received an answer yet. I'll keep you updated as soon as I know more. Alright, so today we are analyzing the accumulating version of this ETF. I will also give you my honest opinion on this fund and tell you what I might actually buy instead. But as always, this is not financial advice, just my own opinions and experiences. Since this ETF is brand new, the information on platforms like Just ETF and Extra ETF is still incomplete. Instead, we are getting our data directly from the source today, VanEck and Morningstar. Alright, so what is this ETF actually about? This fund seeks to provide exposure to the performance of 100 of the top high-dividend companies from developed markets, while reducing reliance on U.S. dividend payers. The strategy is exactly the same as the classic VanEck ETF, just without any U.S. companies in the mix. We will look closely at the exact selection criteria for these companies in just a moment. But first, let's look at the key facts of this ETF. This fund is completely new to the market, having just been launched in April 2026. And here is a major upgrade. The domicile is no longer the Netherlands, like the older VanEck Dividend ETF, but Ireland. So far, about $5 million have flowed into the fund. If we look at Extra ETF, we can see the growth of the fund volume. Those massive jumps suggest that institutional investors have been the main buyers so far. In fact, I only recently became able to buy this ETF through my own broker. But let's get back to the key facts. The management fees, replication method, and the number of holdings are identical to the classic VanEck Dividend ETF. However, the base currency this time is US dollars. I know a lot of people will complain about this and argue it makes no sense for an ex-US ETF. While a euro listing would have made more sense in my opinion, the US dollar listing doesn't actually hurt you. Because there are no US companies in the fund, you are not exposed to US dollar currency risk. The ETF could just as easily be priced in silver coins or bananas. It really doesn't matter. What matters is the currency of the underlying stocks, and the US dollar is not one of them. Alright, moving on. Now we come to the biggest drawback of this ETF. The income treatment is not distributing, but accumulating. This means the dividends are not paid out to your account, but are automatically reinvested into the fund. Don't ask me why VanEck chose this weird strategy. In my opinion, income investors would have been much happier with a distributing version, which the success of the original VanEck Dividend ETF has already proven. If you're enjoying the video, A like and subscribe really helps the channel. Thanks. The incredible success of the classic VanEck Dividend ETF is driven entirely by its underlying index, which sets the strict rules for which companies get into the fund. The new VanEck ETF follows an identical strategy, just without the U.S. The index is called the Morningstar Developed Markets ex-US Large Cap Dividend Leaders Screened Select. So, how do companies actually get selected for this fund? I have pulled the most important rules directly from the official index documents for you. The companies must have positive dividends, meaning the company paid out a dividend in the last 12 months. They need consistent dividend growth, so the dividend per share must be higher today than it was 5 years ago. They require a sustainable payout, meaning the forecasted payout ratio must stay below 75%. REITs are excluded. There is a strict ESG filter. Finally, individual stocks are capped at 5%, and no single sector can make up more than 40% of the fund. From all the companies that pass these tests, the top 100 with the highest dividend payouts are selected. This means you only get financially stable, quality companies that offer a high yield and a reliable track record of dividend growth. The classic VanEck ETF has already proven that this exact filtering process delivers incredibly solid performance. All right, let's check what is actually inside this ETF. To do this, we will first go directly to the website of the index provider, Morningstar. As expected, the fund holds no U.S. assets. These are all large value companies, meaning established, financially strong businesses with stable profits that are currently valued relatively low by the market. We can also see here that the price-to-earnings ratio is sitting at just 12, which is honestly a very attractive valuation. For comparison, a tech-heavy index like the MSCI World has a valuation that is roughly twice as high. Next, let's look at the breakdown by region. Europe dominates the fund at around 60%. North America, which in this case means Canada, makes up 8%. Japan and Australasia sit at around 8% as well. For an ex-US ETF, this is pretty much exactly the distribution I would expect. To get the remaining details, let's jump back over to the official VanEck website. Here we can see the country breakdown. Interestingly, Switzerland and the UK combined make up a massive 30% of the entire fund. Now, let's talk about the sector allocation. Financials take up a whopping 40%. After that, we have energy, consumer staples, healthcare, and utilities. The other sectors barely make an impact, and technology is entirely missing from the fund. Personally, I would prefer it if financials were closer to 20% and the other sectors were a bit more balanced. But that is just the reality when you invest in European dividend stocks. They are heavily weighted toward financials. Finally, let's see which businesses make up the top 10 list. Total, Nestle, Shell, and so on. 90% of the top 10 are well-known, high-quality European companies with incredibly strong dividend characteristics. DBS Group is a banking company from Singapore. I really like this top 10 lineup. They make up over 30% of the entire fund, which is not surprising for a portfolio of only 100 companies and is completely acceptable. By the way, many of these exact same companies also appear in the top 10 of the classic VanEck Dividend ETF. Since this ETF has only been on the market for a few months, we don't have a proper performance history to look at yet. The good news is that the underlying index, the Morningstar Developed Markets ex-US Large Cap Dividend Leaders, has been around for quite a while. Because of that, we can easily check how the ETF would have performed if it had been launched 10 years ago. Over this decade-long period, the ETF would have delivered a total return of around 217%, which is very respectable. What stands out is that it traded sideways for a long time and only really took off since 2022. That is exactly when the shift in interest rates happened. And because this index is heavily invested in financial companies, they were able to benefit massively from those rising interest rates. I would be a little cautious regarding the future here and wouldn't bet everything on the ETF continuing to perform as exceptionally well as it did over the last 3 years. Let's also quickly check how this ex-US index performed compared to the classic Morningstar Dividend Leaders Index. With the U.S. companies included, the classic index delivered a slight outperformance of nearly 20%. So, leaving the U.S. out wouldn't necessarily have paid off in the past. Now, I want to give you my personal opinion on this ETF. I think VanEck's idea to launch another Dividend Leaders ETF is fundamentally very interesting. An Irish domicile and the exclusion of the U.S. definitely sound promising to many European investors at first glance. However, in my opinion, this new ex-US ETF doesn't make much sense because it doesn't pay out dividends. I don't really understand how VanEck came up with the idea to release a dividend ETF with so much potential strictly as an accumulating fund. Many of you will probably complain in the comments, and rightfully so, asking why a dividend fund isn't actually paying any dividends. That said, there are definitely some investors out there who prefer investing in accumulating dividend ETFs. For me personally, this ETF would only become interesting if 2 main criteria are met. First, it absolutely has to be a distributing ETF. After all, when I invest in dividend companies, I want to see actual cash hitting my account. And second, that 40% allocation to financials is just way too high and needs to come down significantly. As a nice-to-have, it would also be great if VanEck moved away from the standard payout schedule of March, June, September, and December. Choosing different months would make it much easier to combine this fund with other ETFs to build a monthly dividend stream. But okay, let's assume you actually do want to invest in an accumulating ETF to build wealth over the long term. This raises a big question for me. Why would you choose a dividend ETF for that? In that scenario, it makes way more sense to simply go with a standard accumulating MSCI World ETF. And if you want to avoid investing in the US for whatever reason, there are plenty of ex-US World ETFs available on the market. The way I see it, since you aren't getting payouts anyway, you shouldn't miss out on the upside of growth companies. Sure, those companies might pay a very low dividend or none at all, but they offer massive growth potential that will benefit your portfolio over the long haul. Plus, a standard MSCI World ETF is much more broadly diversified and usually a lot cheaper too. But hey, it is what it is for now. Let's just hope that VanEck brings a distributing version of this ETF to the market somewhere down the road. I will definitely keep you guys updated on that. All right, that is it for today. What do you think about this brand new VanEck ETF? Would you buy it if they released a distributing version? Or does the accumulating version actually work for your strategy? Let me know in the comments below. Don't forget to like and subscribe. Thanks for watching, and I'll see you next time.